Good evening. My name's Bob Nadler, and I'm an attorney at Legal Aid. I'm sorry we're all convened here for the reason of the flood. And all right. I'm going to hold it in my hand. Again, I'm Bob Nadler, and I'm an attorney at Legal Aid. I'll just tell you a little bit about myself. I'll tell you about my dark side and my good side. My dark side is that I worked for the IRS as an attorney for 30 years, and I left there in 2002, and I've been representing low-income people at Legal Aid in controversies with the IRS for the last 8 years. That's my good side. I have a great deal of experience in controversies with the IRS, and one of the most important things that I've learned and what I'm going to be trying to explain to you is the importance of gathering your documents to establish your loss that you're going to want to claim on your tax returns. Now, tonight we're going to be trying to get to the heart of the matter. I'm not going to try and make you into tax attorneys or tax accountants, because I don't think that's what you need. So I want to tell you a few preliminary remarks before we get into the subject tonight, which is going to be called Casualty Losses in 7 Steps. It's sort of a recipe or a formula, and if you follow the steps that I'm talking about, I think you'll be in very good shape. Now, I want to point out the IRS has a document. It's publication 2194. It's a disaster loss kit, and it's 138 pages, and I'm going to show you some other books. The yellow book is a book I wrote that deals just with flood loss problems, and it's on our website if you didn't get a copy at www.las.org, and it contains 14 issues about recovering records and how to go about getting documents to establish your flood loss. It's 22 pages, so we're working down from 138 pages of the IRS document to 22 pages. But I didn't think that was good enough, so I've got it down to 2 pages. Now, all these steps are not that easy, but there's 7 steps, and I'm going to work through those tonight with you, and then we'll answer some questions. Now, this is called Casualty Losses in 7 Steps, and I'm going to go over the objectives of the 7 steps. The first is how to recover lost tax returns for free. How to get records of your tax payments, and I'm going to explain the importance of your tax payments in a minute. How to create an inventory of furniture, appliances, and personal belongings. How to gather documents to support a loss to your personal residence, and whether you should have your return prepared by an experienced tax person. Now, one of the things you need to know is that after the flood, the President declared Davidson County and 45 other counties federal disaster relief areas, and the significance of that to us tonight is that brought in a whole new set of rules regarding casualty losses and the recovery of income tax returns. So we've got some old laws relating to casualty losses and some new laws, and that's one of the reasons that I'm going to be talking about going to an experienced accountant or tax preparer later, because some of the distinctions make a substantial difference. Now, you all know about tax deductions, but the most important thing you need to know is that in general, a taxpayer has to show the IRS documents to substantiate deductions. Now, you all know about medical expenses and interest expense, taxes, charitable contributions, and miscellaneous expenses. These are itemized deductions. Now, taxpayers can claim casualty losses for certain sudden events, and we can go right through it, that the floods that occurred in May qualify as a casualty loss and can be claimed as an itemized deduction. But they do need to be substantiated by documents to the extent possible. All right, now I need to ask you some important questions, because the recovery of money from the federal government in taxes, a tax refund, is not an insurance program. And basically, you have to ask two questions. Did you pay taxes in 2007, 8, or 9? And another question is, do you owe the federal government taxes right now? Because by claiming a loss this year, that may result in you recovering monies you paid in earlier years, or in the reduction of your tax debt for an earlier year. I'm going to describe a situation in which the casualty loss is not going to be that helpful to a person. A person living solely on Social Security who hasn't paid taxes in a number of years is going to have less of a chance to recover taxes from the federal government, because they haven't paid any taxes in. So this is pretty much individualized to all of you based upon the taxes you paid in earlier years, or the tax that may be due this year. If you had a good year income-wise and you're going to pay some taxes, it may be a good year to claim the loss. Now, I do need to just mention that one of the changes that resulted from President Obama declaring this a federal disaster area is that you can claim this loss in 2009 or 2010. So if you've already filed your 2009 return, you'll have to amend that. And the deadline for doing that is April 15th of 2011. All right, now we're going to go to the first step one. Now, step one is recovering your old tax returns. Now, this is important, but it isn't nearly as important as step two, which I'll get to in a minute. But I want you, if you either lost your past due tax returns or don't have them because you didn't keep a copy, you can acquire a copy for free from the Internal Revenue Service at this time, because we're a federal disaster area. Normally they cost $57 a piece. So if you moved or you just lost your tax returns, you can fill out a form, a 4506, and that's explained in the yellow book. But to make it easy, you can go up to our website. We've got the 4506 on our website. You can fill it out, print it, and mail it in. And then you can get your tax returns for free. So if you had 4, it's basically a savings of $228. Now, step 2 is extremely important, because this is another document you're going to request from the Internal Revenue Service, and I can tell you that every single person in this room should request this record. It's a transcript of account, and what it is a summary of the transactions for each taxable year. For example, 2006, 2007, 2008, and 2009. Now you ask, why would I need that? Because on that summary are going to be any tax payments you made to the IRS. And while your memory may be good, or your Quicken account may be good, or your checks may be good, sometimes there are transactions that you have forgotten. Could be a $1,000 payment or a $1,500 payment, and you don't want to forget that. As a tax lawyer, the first document I get when I have a case is a transcript of account. And you can order these online. I mean, you can go to our website online and fill out a 4506T. There's no cost for this. We've got the address there, and you can send it in. And now I'm going to tell you a little secret. You can go down to 8th and Broadway and get the transcripts of account. You just park your car and go in on the first floor to the IRS walk-in office and tell them you want the transcripts of account, and they should be able to give them to you. Now, there might be a little wait of 15 or 20 minutes, but you can get them in town if you don't want to mail them. You can't do that with a copy of a return, because they don't have it in access to it at the local office. I would say you'd want to go back to 2006, but you could go back a little earlier if you want. Now, step 3, if you're following on the 2-page handout, is make an inventory. Now, I'm going to divide this discussion into 2 parts: the loss to your appliances and your personal belongings, in your furniture and other items, and the loss to your house, because they really present 2 different problems. Now, you need to begin making an inventory of the items that you lost, whatever was damaged or you threw out. And that can be a lot of items, I'm sure. But the IRS has a book that helps. That's IRS Publication 584. And that, I have it here, but basically it has room-by-room schedules that are blank, and it lists various properties that are in each room. And some of those may remind you what was in a particular room, and there's room to add items at the bottom. Now, of course, if you have pictures after the flood of what you lost, or pictures before the flood, which show you what was in the rooms, those are a big help to you in making an inventory. Now, regarding a flood loss, the government, the tax laws require 3 things. They're going to require the original cost of the item, the fair market value the day before the flood, and the fair market value of the item after the flood. Now, that's not as bad as it sounds, because the law requires the government to pay more attention to the lower of the cost of the fair market value. So let's take my sport coat, for example. Let's say that cost $100 and it was completely destroyed in the flood. It's about 5 years old or some length of time. Now, if I sold this, I bought it at $100, that's my cost. I'd be lucky to get $25 in some kind of secondhand sale for it now. So already I know that the tax laws will be looking at the $25 figure. So it isn't so important what most items that are in the home cost. There are very few items like dishwashers and refrigerators and lawnmowers and other things that were microwaves and other things that rose in value. Unlike a house, most of the belongings, at least in my house, went down. Of course, if you have an antique, that might be a little different. But so now I know you might not have the original purchase price for a lot of your items, but you can estimate it. I mean, if your husband bought a shirt for $30 and it was 6 years old, you can put $30 up because it's the fair market as a cost, but the important figure is going to be the fair market value. Now you're asking, well, how will I know what the fair market value is? And that may not be as hard as it sounds, because you can go to the Salvation Army website and look at their donation values, and you can have a good deal of confidence. You don't have to use their values if you think yours are a little more, but if you put a purchase price of $100 for this sport coat and you put $100 fair market value after 6 years, that may work 1 or 2 times, but eventually the government is going to say, why didn't these things go down a little bit? But you can go up to the Salvation Army and they've got donation values, and you can have a good deal of confidence in using those. Now here's something that might be of interest. You need to do the fair market value before the flood. Well, that would be the Salvation Army value in a lot of cases. But you need to know the fair market value after the flood. Well, if you threw it out, I can tell you the fair market value was probably 0, and you don't need a lot of help on that. So it's not going to be impossible, but if you spend some time, a couple hours a week, you know, frankly, for 4 or 5 weeks and you use your pictures and your other information and you get this listed, you'll be in good shape to go to an accountant. Now, step 4 is learn the rules. Now you've got an inventory of your furniture and appliances, and I've explained some of the rules. Now, there's lots of little rules related to this, and you're going to have to make a choice at some point between doing all the reading or relying on your accountant to know what they're doing. And I know in some places it's a tough call, but there are so many little differences in rules that I recommend you gather your documents and you put these values on it like as I'm explaining to you, and later on you go to your accountant. And that's step 4. Now on step 5, we're going to talk about the loss to a home, which is probably for many of you, is your biggest loss, and presents different problems than how much, you know, all your clothing may amount to, I don't know, $1,000 to $3,000. I don't really know. I mean, but it's not nearly what I'm hearing on the loss of the houses. So we're going to talk about that individually. Now, the first thing you're going to need to prove for your loss on your home is your original cost. You're going to add your original cost and any improvements to the home. If you redid your kitchen, if you put on a deck, you add those up. Now, you'll need the papers, and you may have lost the papers, but there's ways to go about finding the papers, and I'm going to tell you some of those. First of all, I discussed this in the yellow book. There's a discussion of how to find the papers, but I'm going to give you 3 possibilities tonight for your original cost. The first is you may have the closing statement from when you bought your house, or your realtor may have that. Another way is to go to the Metro property records, which are at www.padctn.com WebPro. It's right at the assessor's office, and you can go to your address, and among those papers, in a high percentage of cases, it will show the original cost of your residence. And then I've also noticed that Zillow.com, ZILLOW.com, has some original purchase information, which says it's from the property records. So now we've made a good start at valuing the loss to the house. Now, the loss to the house is going to be a comparison of the cost and improvements, that figure, compared to the fair market the change in the fair market value. So you're going to need to know 2 numbers to view the change in the fair market value. Let's say before the flood, your house was worth $180,000, and after the flood, it's worth $100,000. Your loss is $80,000, and so you're going to need to know those 2 numbers. Now, what we're learning in these efforts to talk to groups is that a lot of you had significant losses to your house, and I'm coming around to the opinion that if your loss is above $15,000, you should be giving serious consideration to an appraisal. And we have 3 gentlemen who are appraisers here who are doing good work. Would you all just raise your hands, please? And they'll be available after my presentation later this evening if you want to talk to them. But there's significant benefit to getting an appraisal, because if you write on your return that you had a $45,000 loss and you don't have anything to back it up but your opinion, or you think you've got some comparables, the IRS is likely to resist. But if you pay for an appraisal and you bring an independent opinion, a person who has experience, their opinion to the table, it'll have a strong effect on you getting the result you want in a quicker period of time. And I have listened to these gentlemen talk about appraisals, and I can tell you that they really know what they're doing. They've been valuing flood properties since the flood, and they have a wealth of knowledge and can be of value to you. I received a telephone call from a man in Bellevue after we made a presentation out there, and he had engaged an appraiser, and he told me that he had a $70,000 loss. He lived out in River Plantation. He was really happy because he felt that he was going to have a good chance of making some progress with the IRS. The question is, what if you've redone your house and you've upgraded it considerably? Well, there's two issues there. Number one, the appraisers have indicated that that's not a problem. But remember, you're appraising it after the flood and before the flood. So if it was worth $150,000 before the flood and you had $50,000 of damage, your loss is going to be $50,000 even if you put $100,000 into the house. Are you following me? You're limited to your loss. You're going to have a $50,000 loss whether you put $10,000 back into the house or $150,000. And you can get information about the cost of your property from them. They're being very helpful. All right, just a further comment about appraisers is they're going to take into account current market conditions that you may miss or not understand. And I can tell you, I talked to appraisers right after the flood, and they were kind of they were challenged by the developments of the flood and the changes to the land, but five or so months later, they have worked through some of these problems, and they have a lot of expertise and have solved a lot of the problems. Now, based upon my experience with the IRS, I can tell you without any hesitation that if you claim a large loss, $40,000 or $50,000 or more on your house, and you put on the table a proper appraisal that's done by a professional, I mean, the IRS in a very small number of cases will get an appraisal, but I would say it's less than 1 in 50 cases. So they're not gonna push back very much unless your appraisal is really bizarre, and I don't think that's what you're gonna get in this city. All right, I'm coming close to the end. I'm on step 7, and I've got to kind of tell you a story. What I've been talking about tonight is gathering documents and putting you in the best position. Now, step 7 is basically a discussion of who's going to prepare the return, you or whether you should go to an accountant. Now, I'm going to explain how I feel about that. I've given you basically a recipe for getting in a position to claim your casualty losses. Well, I want to make an analogy to Thanksgiving dinner. If you know, you can go on the Food Channel and on the internet and get a recipe and get all the ingredients. Well, you can get all the ingredients for Thanksgiving dinner. You can go to the store and buy a good turkey and cranberries and the ingredients for stuffing and garlic and all the things that you need. Now, if you bring those to my house, you got 1 or 2 people that can cook that dinner. I never cooked Thanksgiving dinner, and my wife has cooked 34 of them. Now, I just want to know, who do you want to cook that Thanksgiving dinner? And that's where we are here. The accountants are very experienced. They know the rules. They're going to prepare a lot of casualty loss returns. And my opinion is that if you can, you ought to give serious thought to having an accountant prepare the return this year. Now, I'm going to explain some of the reasons why this year is different. You're going to have to, you and the accountant, or you alone, are going to have to make a decision whether to claim the loss in 2009 or 2010. If you claim it in 2009, you're probably going to have to amend the return, and that's its own complication. If you claim the loss in 2009, you can add the casualty loss to your standard deduction. That's a very peculiar thing. Normally, you either claim the standard deduction or itemized deductions. But in 2009, you can add it to the standard deduction and do it that way without claiming itemized deductions. In 2010, you don't have that choice. It's an itemized deduction. If you receive money from FEMA, in certain cases, that will have to be considered in the computation of the loss. In certain cases, you will be able to carry the loss back to an earlier year and recover taxes. That'll involve amended returns. Another consideration is that if you don't have money that you can recover from earlier years and you're past 59.5, and you've had a loss, you may want to discuss with your accountant the possibility of drawing money out of your retirement account. Because if you have a big loss, that would offset the tax that was due on the removing money from your 401k or your IRA account. Then there's the possibility that some of the property that you bought to rebuild your house had tax credits, and an accountant would be able to advise you on that. Then a further consideration, as I discussed at some length, is whether you should get an appraisal. That may be something your accountant could be of quite a bit of help. If you have an appraisal and the accountant thinks that appraisal will work, that may work very good. And the final question that you may want to take up with your accountant, there are some deadlines. Now, most of them are April 15th of 2011, but you know, there's certainly a different deadline on the state sales tax refund, which currently is November 30th. Currently, to file for purchases have to be by today. But if you've made your purchases, you have till November 30th to file. Well, I don't know what to tell you, but there's some consideration of them lengthening the time. But right now, your purchases had to be, as of today, the law is they had to be by today. I think that's correct. Yeah, that would be its own itemized deduction. Now, I just want to tell you about some other resources. On our website, we've got the 4506 and the 4506T, and the yellow book is there for anyone who didn't get a copy. And then, this is shameless self-promotion, but I did a video. It's pretty dry in case you want to hear basically this talk again. But that's pretty much it. I've really enjoyed talking with you. I'm very sympathetic to these problems. Where I was hoping by coming out and speaking to you about gathering documents that it would give you some direction and give you some control over this problem.